if your contract includes a significant financing component, so your revenue must reflect the cash selling price of your product and services. And in light of this general rule, your company has two scenarios if the contract includes a significant financing component. The first scenario is your company is going to deliver the product and the services today to the customer, allowing the customer to pay the company after 2 years, for example. And as long as the payment will be in a period more than 1 year, so we are calling this payment as payment in arrears. Let's understand the case. If the company is going to deliver the product and the service today, and the customer is going to pay the company after 2-3 years, for example, so effectively the company is financing the customer. The company is giving a loan to the customer, and for that reason we have to recognize interest income or finance income in the financial statement, and this finance income will be reported separately from the revenue in the preparation of the financial statement, and specifically in the statement of the financial performance and the P&L. The second scenario, that the customer is going to pay the company today and the company is going to deliver the product and the service after 2 years. Effectively here in this scenario, that the customer is paying in advance, and the customer is financing the company because the customer is paying in advance, and the company will take this money to manufacture or to purchase the product and the services and to deliver after 2 years. So the company is taking this money to run the operation. So that's why I'm saying that in this scenario the customer is financing the company and the company is taking a loan from the customer, and for that reason the company must recognize finance cost in the financial statements and specifically in the P&L, and the revenue should be adjusted to reflect the increase as a result of this finance cost. We are going to take examples of all of these cases. Now let's recall back again the example for the real estate development company that's going to sell an apartment to a customer over a long installment plan for 10 years, for example. The revenue that this company should recognize for this unit that the company is going to sell the customer should reflect the cash selling price of this apartment as of today. And if the company doesn't know the cash selling price of this apartment, so the company should calculate the present value of all of the future cash flow. In order to calculate the present value for all of the future cash flow in this installment plan, the company must determine a discount rate. This discount rate should reflect the credit risk of the customer. So the company should determine a discount rate that is different from one customer to another. It depends on the credit risk and the credit profile of each customer. Number two, this discount rate should reflect the collateral and the security that the customer is going to provide to the company. So for example, if the customer is going to provide a security, for example, or a collateral to the company, so the discount rate should be decreased, because actually the company now is in less risk or low risk in dealing with this customer. So the discount rate should decrease in this case. So now how can we calculate this discount rate? Simply on the Excel file or in the financial model, the company can determine the rate that the future cash flow will equal to the cash price as of today. So this will be considered as the discount rate. Now we have a question here. Is this discount rate updated? I mean that if the credit risk on the customer changed after 2-3 years, for example, should we update this discount rate? The answer is no. We should keep the discount rate that we determined in the first day of the transaction as it is, without any changes up to the end of the contract. So this discount rate is not updated. Now comes to the next question. How can we present these transactions in the financial statements? As I have just explained before, that the revenue from the goods and the services should be separately presented in the income statement from any part related to the financing, whether this finance is a finance income or a finance expense. So the finance income or finance expense should be presented separately from the revenue that we are going to determine for the goods and the services, and this revenue should reflect the cash selling price. Let's take example on Excel in order to show the full accounting entries under both scenarios, if the payment is going to be in arrears or if the payment is going to be in advance.